All right, there is another look at the U.S. futures. It looks like a positive bounce is up, at least in the early trade. Yesterday was a wild ride that saw markets travel deeply into negative territory, steeply into positive territory, and then come back to earth again by the time the trading day was closed. Let's talk about all of this with our first guest of this hour. Philip Petursson is Chief Investment Strategist at IG Wealth Management. Philip, thanks for being here.
Please be here.
So what do we make of this? We've had steep declines. Obviously, it looks like today could be a positive day. How should investors understand this?
Yeah, I think that today will be, judging by the futures, also by judging by yesterday's market action. And so what we saw was a wild swing yesterday from bottom to top for the S&P 500. It was an 8.5% move, and that's a pretty significant move. What that told us is that you had the selling pressure early on, but then the buyers started to come out. There's a number of different indicators that we follow that are suggesting that we might be at that peak fear moment when you can start to dip into the market and take advantage of the market volatility that we've seen and the much cheaper prices.
That rally that took place at about 10 a.m. Eastern time yesterday was driven by what was later described as a false report about a 90-day freeze on the tariff situation from the White House. But that does seem to tell us a lot about how markets would respond if we got some real and durable news, positive news on this tariff situation, correct?
Exactly. But also look at how we ended the day. So yes, you had that, we can call it like a fat thumb or whatever it was that drove the market up there. But we ended the day just modestly below where we were on Friday. And so that, to me, also is a positive signal. You had the buyers and the sellers kind of pushing each other at the same time. And so you really didn't get, while you saw a lot of movement during the day, at the end of the day, you didn't see a lot of movement. A few of the things that those are encouraging signs. Plus the fact that Friday, if you looked at it, it was a very, very sharp down day, and the highest volume that we've seen on the S&P 500 ever. That tells us that the sellers were out in full force. There are probably still some sellers out there, but maybe not as many as we saw last week.
So you believe a bottom is forming in these markets, correct?
We do. We think a bottom could be forming. You never actually know until well after the fact, but let's go through some of the data. Friday being one of the worst days over the last 75 years. It was the 20th worst day if you measured on the one-day basis. On the two-day basis, it was the 5th two-day worst period for the S&P 500 going back to 1970. If you look at environments like that, you're positive, close to 90% of the time 1 year forward with average returns between 20 and 35%. That's encouraging. If you look at the VIX broke above 30 last week, stayed above 30 yesterday. When the VIX is at this level, it does tend to indicate that we're at this peak fear moment. Now, it can stay elevated and we can continue to see some downward pressure, but the market was down as much as 20%. How much further do we have to go? When the VIX is at this level, you're positive 87% of the time 1 year forward with an average return of 22%. So these are some encouraging indicators that, yes, a bottom could be forming.
But we don't know where the tariff narrative is going, correct? Would you agree with that?
Exactly, you don't.
And that's the dominant driver here, correct?
That's exactly it. That is the one unknown, the shock to the system. But we continue to describe this as more of a disruptive event than a destructive event. Now, a destructive event leads to a permanent loss of capital. We don't have that right now. Right now, this is a little bit more like COVID, I would say, a shock where we have pauses in aspects of the economy while everyone's trying to figure out what to do. That's being priced into the market. But have we priced in enough? I think we're close to that point.
What's it telling us? That some sectors of the market have done quite well. Gold has held in. The utility stocks are down only slightly this year. The grocery stocks have done well. The classic defensive is doing well.
Exactly. It tells us that, for the most part, life will go on, right? Companies will figure this out. And for the average person, while it's an annoyance, and we're going to have to think about how we're spending our dollars if prices are going up, it's not going to stop the economy. It's just going to slow aspects of the economy down. So yes, defensives have done well. Gold has done well. We think it can continue to run. This is where diversification has been the portfolio's best friend. And if you've been diversified going into this, then coming out, it's not nearly as bad as, say, the S&P 500 alone would indicate.
So for many investors, being diversified would have meant, in the past tense, in the past couple of years, trimming exposure to tech stocks as perhaps that portion of your portfolio got larger. If you were a holder of NVIDIA or other Mag 7 stocks that went through the roof for a period of time, being disciplined on those holdings would have been key to where you would stand right now, correct?
Exactly, and especially coming into this period. You know, what was the one certainty we had post-election is that Trump favors tariffs, and tariffs can be disruptive. So into this environment, yes, you know, it was the advantage, or it was to the advantage of the investor to say, okay, where do we have the greatest amount of potential downside risk, or where do we have the largest margin of safety? So trimming your profits, your excessive profits that we've seen out of the U.S. over the last couple of years, moving to like rebalancing into fixed income, rebalancing into gold, rebalancing into international stocks, has served the investor very well.
Canadian stocks, if you consider the S&P TSX Composite to be a reliable bellwether of the Canadian stock market, continue to outperform U.S. stocks. Your thoughts?
Yes, we think they will too. So if you look at the S&P 500, we view the S&P 500 companies as more tariff sensitive than the TSX companies. TSX companies dominated by miners, dominated by the energy companies and the banks, we would say overall are less tariff sensitive. And so, yes, they're being caught up in the volatility, but are they going to see significant headwinds to their businesses? Probably not.
Philip Petursson, thank you as always for your insights.
Thank you.